Well, first of all, I was quite shocked about the aviation news. To come back
Right.
to the banking sector, everything is within expectation. Actually, just 1 month ago or half a month ago, the Central Bank of China has offered in like 1 trillion yuan of its benefit earned last year to the whole banking system, which actually has been offering the whole banking system an extra 1 trillion yuan. So, which actually eased the pressure of the whole banking sector on assistance on the liquidity. So actually, the LPR can be naturally induced to go down a little bit. But I think the central bank has already made the decision just to hold this move for a little bit because, as far as we can see, that the whole system actually has a lot of liquidities floating in the commercial banking sectors. The problem is not about the banking system or the liquidities. It's actually about the pandemic and also about the uncertainties caused by the Ukraine crisis and some other issues. So, which lead to the SME, the enterprises. They are hesitating to lend more, so they're not sure what's going to happen in the coming next 1 quarter or half a year. So I think the most important thing is to calm them down and give them more certainty and give them more support from this fiscal and or from the subsidy of the government. So I think the monetary policy just goes a second. But I'm still sure after 1 quarter or two, the central bank will still make a stable but firm move to help the enterprises.
So, in your opinion, are there any chances that we might see an interest rate cut maybe in the second quarter of this year?
Well, that might be a very, very large possibility because the central government on the the central government economic work conference has made it very, very sure that the central bank or the whole financial system should make a steady and firm steps to help the SMEs, to help the whole economy, and also the monetary policy should be bold but also very stable and strong. So I think with this attitude, I think the monetary policy actually have many, many tools still deep in the pocket of the central bank. There's still many tricks to turn. But the thing is whether we need it right now or we should solve some other root cause first. So I think, yes, there is a possibility.
And Dr. Qu, China sent out a strong message last week urging our government departments to actively introduce policies that benefit markets. What do you make of the move and what signal does it give about China's monetary stance for this year?
Well, I think the Chinese monetary stand and the policy target is actually very, very predictable. That is to help the whole economy and to stable the price. But currently, as we are seeing, that China still have a very, very large leeway in the monetary policy. And the whole target is to maintain the dynamic of the whole economic growth, which we still need to stabilize people's expectation right now. For the pressure on the price, I think that gives our central bank lots of space. If you take a look at the financial market, take a look at the rise of the housing price right now in China, we're on a very contradictory situation to USA, to Japan, or to the European market. The price is actually in a very, very low status, and the market is far from being overheating. It's actually just a little bit warm. So I think we still have the space to expand our balance sheet of the central bank and to make more bold move to support the economic growth target.
And there, as you mentioned, there's a difference compared to China's economy and the external environments. Now, with the U.S. entering a rate hiking cycle, what do you think the capital outflow pressures on China would be due to its independent monetary policies?
Oh, yes, indeed. China always pursue a very independent stance in the monetary policy as well as the economic policy, since China has a limited open capital account, so which isolated a little bit Chinese capital market from the world risk. This is for one thing. Another thing is that I'm glad you mentioned about the interest rate hike in the United States by the Fed, and also probably followed by the European market. But I don't think that is a very sustainable stance by both Fed and the European Central Bank. The reason why for that is that we're seeing already very, very strong signals for the inflation in the market, and also the very high pressure for the overheating in the assets market in Europe and in America. And also we're seeing the whole economic momentum in the USA probably is going to slow down a little bit. So I think the Fed still will have a pressure on maintaining the dynamic of the recovery after the pandemic. So I think their hike for the interest rate will going to be very cautious and slow. So which also gives China another opportunity just to think our cycle of monetary policy a little bit with USA.